Okay, here's the riddle for the day. How is Whole Foods like IBM? And I don't know what you're going to come up with, but here's my take. They both are signaling the potential end for a strategy that has propped up stock prices for companies that aren't showing any earnings growth. In the case of IBM, they basically have announced, something like 4 or 6 quarters of no revenue growth or negative revenue growth. And they've managed to get earnings growth during that period by buying back shares. Because you have fewer shares, you take the same earnings, you spread it over fewer shares, your earnings per share goes up. On November 6th, Whole Foods Market announced its earnings. And they did a very typical thing for the quarter in terms of they beat by a penny, but they saw revenue fall, and then they talked about, they lowered guidance for the rest of 2013, 2014. What they did, and the reason the stock didn't go down, it was up about 1.25 percentage points that day, is they also announced they're going to do another buyback. They still have about $300 million left from their last buyback, but they announced another $500 million for authorization through 2015. So they'll buy back another $500 million worth of shares, which means, again, you'll have the same earnings, but spread over fewer shares, so earnings per share should go up. And they also announced a dividend increase. Sounds great on paper because they said it was a 20% increase, and it is indeed a 20% increase. But Whole Foods only pays 10 cents as a quarterly dividend. And if you're looking at that and going, oh, okay, so this is a $64 stock, a 20% increase on that really doesn't add up to very much. You're looking at a return of a dividend rate of less than 1%. So, but these are things that companies normally do to support their stock price. And one of the things that's kind of worrisome here is that even though that's what Whole Foods said it was doing, spending all this money on buying back stock and on dividend payouts, they also said, well, we continue to grow stores, we see rising return on investment, and you put these two things together and they really don't go together very well. It's one thing for IBM to be saying, well, we're going to support our stock because we're really by spending cash there because we really don't see any place else maybe to spend it. But for Whole Foods to say, well, if we grow more stores, we're seeing a rising return on investment. As an investor, you'd sort of go, well, I don't care for this, extra 2 cents in dividends. I'd like to see you, open more stores if that is indeed where you're getting the best use of my cash. So you look at this and you go, well, is it really that they're seeing less growth possibilities, or they're just being cynical and propping up the stock because, maybe the CEO's compensation is tied to it? So what's going on here? And I think we're starting to get more and more questions about companies' growth strategies, how much growth there can be, and what the best use of company cash, which means investor cash, could be. And that's really a different state of mind for the market as we head into the end of 2013 and look at sort of anemic global growth in 2014. This is Jim Juback for Juback Asset Management.